Good morning, good afternoon, good evening, depending where you are on this beautiful planet. And welcome to the TGI Friday. Thank God it's Friday, the 25th of March, 2022. Bull vs. Bear webinar with Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go through our usual regular run through in here today. Apologies, we couldn't be on yesterday, but we're back here today. We're going to take a look at the calendar, what we've had, what we've got coming up. We will take a look at some articles, reports from the major news wires, what's impacting markets right now from a macroeconomic, fundamental, geopolitical perspective. And we will also take a look at the charts to see what's going on and where we can potentially enter some trades today and where the support resistance levels are. So from my perspective anyway. Let's take a look at what we've had coming up. We have some important European data today, not really impacting too much on and any of the markets we're looking at. We had retail sales at the UK, slightly missing in here, slightly below expectations, see all in red in here. And then the German IFO Business Climate Index in here. So this is a survey index in here, missing and beating in various parts of that. So kind of a mixed bag in here from Germany, slightly weaker than expected. Remember, weaker than expected, probably slightly positive in here, given the markets are very, very strong, not markets, given economies are very strong, the UK economy very, very strong, tight labor markets in here. And inflationary pressures. So weaker retail sales, if anything, probably seen as a positive for the overall economy. So the economy may be slowing slightly. That's what we want, slowing slightly, but not too aggressively. Looking ahead, what we have today, really nothing of real major consequence. We do have Williams speaking from the Fed, probably not going to get too much from there, and also Waller. And then we get the Michigan consumer sentiment data, can have an impact, but given the backdrop of all the geopolitical tension that we have, I wouldn't have thought Michigan consumer sentiment. Excuse me 1 second, guys. I need to clear my throat. Have a drink 1 second. Sorry, guys. The Michigan consumer sentiment data, I don't think that's going to have too much of an impact. However, that is at 10 o'clock today, Eastern time. So watching out for that. Right, where are we going into today? Well, we had another positive day in here. Let's kick off with what the US did yesterday. Another positive day yesterday. S&P and the Dow Jones up 1.5% in here, Nasdaq also higher. And this morning markets have kind of slightly dipped and slightly rebounded, kind of marking time through the morning. We're up on the futures indices are around between a tenth and 0.2, up between 0.1 and 0.2% on US futures. And if we take a look at Europe in here, slightly better performance from Europe in here so far this morning. We've had markets up between 0.25 and 0.75%, pretty much across the board, between 0.25 and 0.75% for most of the European indices. Now, one of the drivers of that in here, and we'll go to 5 things to start your day. Joe Biden and the EC Commissioner, EC President here, Ursula von der Leyen, announced a pact to boost Europe's supply of liquefied natural gas by the end of the year from the US. Okay, so that's certainly a positive. And then Biden's obviously been in Europe this week, meeting NATO, G7, EU leaders, ramping up pressure on Putin. And we've seen natural gas, liquefied natural gas potentially coming from the US. Now, that deal probably slightly less than the market would have wanted in some ways, but at least that deal has been done, and that's seen as an overall positive in here. And so if we see in here, look, EU von der Leyen under the deal, US liquid natural gas will replace that of Russians. Okay, both speaking. Well, actually, that this is in the past. So, but yeah, so got to be seen as overall as a positive. But the problem is that the US LNG plants are already producing at full capacity. Means that most of the additional gas going to Europe would have to come from exports that would have gone to other parts of the world. So in some ways, it's taking away with one hand and giving with another. But nevertheless, it kind of takes the pressure off of European natural gas prices, and also then means less reliance on Russia. It's another impingement on Russia as well. Another that's kind of it bolsters the sanctions on Russia. So you've got to see those as basically positive outcomes. Ukraine is pushing back counterattacks. They've reoccupied some defense positions in the area of Kyiv, so that's seen as a positive as well in here. But also there's EU officials suspect that China may be ready to supply semiconductors and other tech hardware to Russia, soften the impact of sanctions. The curve. Now, the curve, this was brought up on Monday by Jerome Powell, went a little bit underneath my radar earlier in the week, but I picked up on it in the second half of this week. Noticed it yesterday. So obviously we've been talking anyway about the curve flattening, and often when the curve goes inverted, often it's looked at as the 2-10s part of the curve. So the yield curve, the US yield curve, the difference between the 2-10s curve is basically the difference between the 2-year yield and the 10-year yield. That's simply what it is. And when that inverts, or sometimes people look at the 5s to 30s, sometimes they look even a shorter time frame out to 10, so maybe even like a 3 months out to 10s. Okay, but if that inverts, that is a lot of the time in the post-war era, post-World War II era, that is signified and been followed in the 1 to 2 years after by a recession. Not always. There have been some instances where it's just inverted slightly and we haven't seen a recession on the back of that. Nevertheless, it is a bit of a concern. Okay. However, Powell did state earlier in the week that the 2s10s is not what we should be looking at. That spread isn't the one you should be looking at, according to Federal Chairman, which weighed in on the debate to remark that the short end of the yield curve has a greater predictive power of recession. So this is his view that the short end has. And if we go in here, or where have I got the article in here? So Powell says, look at the short-term yield curve for recession risk, right? This is what he said on Monday. He points to the spread between the 3-month and the 18-month forward. So the difference between 3 months yields and 18-month yields. And those yields are still very, very steep, okay? They're nowhere near inverting, okay? So here's steep short-term yield curve. Signals risk of imminent recession. And currently, this is where it inverts over here. You can see there's an inversion, recession. Inversion, recession, yeah, inversion, okay, in here, and then recession, okay. But here, look where we are. We're all the way out here. So the 3s to 18s, okay, are nowhere near inverted. In fact, a long way from inverted. So that's seen, according to Powell, that's a better, okay. Powell, in response to a question at the National Station for Business, that's really what the 100% of the explanation of the yield curve. Okay, so he's talking about the 18-month. Okay, so the 3 to 18 months. So that's interesting. That's way. So I thought I'd wind back on, and they're covering here. Markets relatively calm. We've kind of gone through the markets. European, where it says in here they're flat when this was written, but European stocks up, and US futures slightly up as well. And then we've got that University of Michigan data later on. We've spoken about Van der Leyen. So US futures drift, stocks rise, treasury is steady. Okay, so we've already kind of covered through on that. These are just the heads up for the day. Wall Street worries that Fed was behind the curve on inflation. Okay, so the Wall Street markets, so a source close to JP Morgan said that he was now predicting 12 to 15 rate hikes. I cumulative 300 in this hiking cycle, so a lot more than anticipated. Okay, we're talking up to 15 rate hikes, 370 basis points up. This is an increase from the 6 or 7 hikes predicted in January. Okay, so they're thinking that maybe the Fed is behind the curve coming out of JP Morgan. And again, in year futures ed higher as tech stocks resume the climb. So tech has really been the leader on the way back higher in here, and that's despite, remember, yields spiking higher. Normally, higher yields are negative for growth stocks, more negative for growth stocks, and more negative for growth stocks. Then that falls into all the tech and the Nasdaq, and we certainly saw that to some extent on the way down. So on the way down, when markets were selling off and yields were going higher, the tech was definitely outperforming. However, on the rebound in tech is outperforming on the rebound. Okay, so underperforming on the way down, which was anticipated, expected because of higher yields. However, yields continue to go higher, right? Although at the moment we have a little bit of a respite. If we go and take a look at the bonds. Okay, I'm going to go put the daily bond chart up in here. We had a little bit of a respite over the last few days in it, but we're still pretty much sitting down here on bond price lows equals yield highs. Okay, so we're sitting still on yield highs. Okay, but tech is leading the way higher. Tech outperforming. Yes, certainly. We're not seeing an underperformance on the way back up, even though yields are high. So that's certainly would be seen as an overall positive for the market. So tech leading on the way back higher. And then the next article I wanted to focus on in here, this is going to be, given that we finish, given we don't get a big rout lower today, given that we had a really stellar week in here so far this week, we'll look at that shortly, but markets up significantly, equity indices. But stock markets, second consecutive weekly gains for the first time in 2022. So we haven't had back-to-back weekly gains on world stock markets in here all of this year. Okay, and so world stocks headed for the for a second consecutive week, for the first time in 2022. Okay, and this was obviously going right into the end of the first quarter. Now we've already spoke about Powell on the yield curve. One thing I just wanted to dip in on in here is we don't really talk about much about currencies. I often don't talk about currencies on some of the other businesses I'm involved in. I talk a lot about currencies, but we tend to not have many people trading the currencies on the platform. So I tend not to go into too much stuff. I just wanted to touch on this. Dollar yen is spiking higher. So the dollar has been basically initially through the beginning of the crisis, through early February, March, the dollar was super strong. And if we go and take a look in here on the dollar index, I've got on here where we are, the dollar index. So you can see in here, as we had the outbreak from February here and through early March, the dollar was super strong. And that break higher in the dollar was as a rush to a safe haven. The dollar becomes, when we're in super crisis, right? So often the yen is seen as a safe haven amongst currency markets. But the dollar, when we're in super crisis kind of time, which we, obviously were as the invasion started, then the dollar, everyone wants to own dollars, right? So the dollar and then spiked significantly higher. Since then, the dollar's been kind of sideways in here. But if you took a look at the dollar yen chart, and I'm hoping they're going to have it on here, so maybe bringing up they've got it in there. You can see it here. Dollar yen's continue to go up and up and up and up. So the yen that's the dollar up, the yen down. The yen has continued to weaken against the dollar because since going back to this chart in here, the dollar has stabilized against. So this is the dollar index against the euro. In fact, anything against the risk currencies, Aussie, Kiwi, CAD, the dollar's lost ground in this phase in here in the last 2-3 weeks as we've gone back into risk on mode. Those risk currencies, Australian dollar, Canadian dollar, New Zealand dollar, have all performed very well. Even the euro and the pound have started to rebound against the dollar. So the dollar's weakened, if anything, and you've seen that in here in the last couple of weeks. It's weakened in here against many currencies, but continue to rally against the yen. And that means obviously that the yen is losing ground to everything. So if you look at Aussie yen is getting absolutely crushed in here. And I'm often worried about adding a new tab. Oh, it's worked in here. I'm hoping let's just do, I'll just put AU now. Aussie yen, just for a little bit of a bit of teaching here, if you don't know, Aussie yen is often viewed as, I'm hoping I'm not going to lose this. Aussie yen, let's bring it up on trading view in here, and I'll go to the launch view chart. Oh, I don't want to do the sign up. Oh, I've already got an account, but I don't want to allow me to launch the chart without signing up. Yeah, I think so. But Aussie yen is often viewed as what we call a risk proxy. Okay, there we go. I don't need to sign up. So in here, look at Aussie yen. Massive move higher in here. And this is both Aussie rallying and yen. And this is because we've gone into risk on mode. Okay, going into risk on mode. This is a daily chart. It doesn't look like a daily chart with that move, right? Huge move higher in Aussie yen. In here, it's up like it's about 8% in here. Where's the measuring tool? So this is in like a week and a half. Aussie yen, we're up 8.9%. But over 8.5% in here for Aussie yen. So a super strong move higher in Aussie yen in here, and that on the back of Aussie rallying as we got into risk on, and the yen selling off. Now the yen is not only selling off because we've gone back into risk on mode, but as they're focusing on here, yen unraveling, risk collapse to 1990 levels as Fed oil away. One thing is, right, Fed are obviously on their rate hiking cycle. They've signaled that they've shifted more and more hawkish as we've gone through the Q1 of this year, Q1 2022. And certainly we've seen an even more hawkish stance from the Fed since they've hiked rates in here recently last week, and then in the tone coming through from Powell. Now, remember, we've been at zero interest rate policy for one of the big drivers of FX currency pairs is the interest rate differential, right? Interest rate differential between the two currencies, the interest rate. And remember, we've had zero interest rate policy in Japan since the 1990s, right? The late 1990s. We're over 2 decades, well over 2 decades into zero interest rate policy. And there's been no talk. There's been no prospect of Japan. Okay, they are seeing some inflationary pressures coming through, but there's no prospect. There's no talk at the moment of Japan raising interest rates. So with Japanese interest rates effectively pegged at zero and the Fed hiking rates and becoming more and more and more hawkish, that makes dollar yen more bullish, okay, and points the dollar higher versus the yen, and not only against the yen but against other major currencies. Okay, so we're seeing the say we just looked at Aussie yen there. It's partly because of that, okay, the interest rate differential, so because of the Fed, and also oil. Okay, so because the oil price is high, and because Japan is a net importer, doesn't produce any oil, net importer of oil, large net importer of oil, that's negative. Just like the Canadian dollar benefits from a higher oil price because it's a net exporter of oil, and it's a strong exporter. A strong oil price, which we've seen in here, is negative for the Japanese currency as a significant net importer of oil. Okay, and also generally rising commodity prices. They're an importer of commodities, global economy, commodities as well. So just wanted to touch on that as well. Right, let's talk about the markets. Right, going to come off the go back to the stock indices in here. Let's start with the stocks. Okay, I'll just do a little whistle top tour in here. We spoke back. We didn't really speak yesterday because I wasn't on, but we had actually a move lower in here on Wednesday, so it was negative. You know, we're looking for a more bullish move there on equities on Wednesday. Didn't come through, so a notable setback. Did warn though that it did look a little bit vulnerable. I was looking for a dip. Remember, initially on Wednesday, I said initially lower and then a rebound. Well, it was initially lower, and then finish off the day lower. So, but then turned around, really strong recovery, another new recovery high here, and then pushing higher here this morning. Now, this is in the crosshairs, these peaks in here. So we've got peaks in here back from running through from the 10th of February, the 9th of February, and the 2nd of February. These peaks are at 45.73 and a half. Oh no, that's wrong. Scrap that. 45.76 and a quarter, 45.78 and a half, and 45.78. So 45.76 to 78 is going to be key in here on the upside. Now, I know we're still some ways away from that, but nevertheless in here, I think there's real risk in here that the market goes and challenges those. I would say they're targets for today. I'm not talking about using these. And you also got this failure peak in here around the same kind of level. That's at 44.584 and a half, and another failure peak there, 45.95 and a quarter. So I think anywhere between like 76 and 90, you know, in the 90 kind of area, that's kind of the target in here for today, minimal target, and we could go even higher through there. I think it's going to be a real positive end to the week. I think we're going to see this FOMO rally. Part of this has been a FOMO rally, fear of missing out rally. Okay, and I think we could easily see that extend into the weekend. We're back here when we had all the fear and panic in the market. Markets were finishing Fridays very, very weak in here. Who wants to go home the weekend when you've got a war raging, right? But now that's kind of behind us. The Fed rate hikes behind us, and now we've got a fear of missing out rally going on. And I think there is a real threat for a squeeze higher to these target peaks in here today. If I step in, I'm on a 5-minute in here. But you can see in here, 5 minute, the market's retraced lower and back higher. But let's just step back a little bit first of all and look at the 30-minute in here. So here's the 30-minute. There's the positive price action in here from yesterday in here. Really strong rebound in here. There's Wednesday back lower. Thursday made a new high. And then already look this morning, dipped and rebound. And if we look at the trend line in here on this, actually, let me get rid of all these other drawing tools. If we look at the trend line that comes up, this one's going to be no good to us. Actually, let me just. So these trend lines, if you draw a trend line through here, that's one's going to be redundant. I wouldn't redraw it through this low here. The trend kind of comes across from here. So I would say that this is where the kind of the more shallower trend kind of starts from in here. I think this is legitimate through here. And then we say this is D4 on apply. Okay, so look, so you get through here and through here, you get a touch here and you get another touch here, and the market's dipped and rebound away from that. Now, if we zoom in a little bit in here, you've also got, I would focus in on, so this was yesterday's move higher, okay, and then where were we at the close? Yeah, so this is the close yesterday. Now, what did we do from that? When we had this little tiny dip and another little tiny dip. I don't even really need to put the Fibonacci retracements on, but if you just look at yesterday's up move in here, which was this move here, that's just yesterday's up move. We didn't even look, we held, see here, the 23.6% retracement. We didn't even dip to the 23.6. That's the very minimal first retracement level. It didn't even dip to that. And actually, you see that it goes higher and then actually dips to it here. But then you'd redraw this one. You know, you take this from here and expand it to here. And look, on this one, from the whole move from yesterday to the overnight high, it does just dip between the 23.6 on this higher move, but then it holds just above the 38.2, swings higher, and we're back higher again. And if we step in now, like onto like a 5 minute in here, there's the rebound in here, the push higher again, dipping now. Now, anywhere back into this area here, I think somewhere between, I don't know, 45.20, 45.16, that's your buy zone. You've got an obvious stop out level there from about 30 minutes ago, this swing low, which would be at 45.16.75. I'd probably want a deeper stop in here. I'd be buying this area, stopping here somewhere for a next big up move. I would, I'm not in here scalping. What I'm looking in here is like for a dip into here, maybe a stop even all the way down here, but looking for those bigger targets up in the 70, 80 kind of level, looking for like a 40-point swing on the upside in here today, so I'd be looking for that and minimally hoping to get 25, 30 out of it. So at least having like a 10, 15 index point stop. Okay, similar story for the NASDAQ on the daily. Again, look, dipped Wednesday, really strong Thursday, impulsive move higher again. Now you can see of the whole sell-off, this is the sell-off, remember, right from the top. It's actually not from the very top in here. We've got the top in here from the 22nd of November, but this is the sell-off from the very end of last year, the 28th, so just after Christmas. In here, there's the whole sell-off in here of this down move. And you can see the market this morning has pushed above the halfway point. And these are now obvious targets for me. These peaks in here from the 10th and 9th again of February, and maybe even that 2nd of February peak. So from the 10th and 9th, we're around 1555, 1570, and then you got the 61.8% and that peak. So the 61.8% is around 15235, and then the peak there 15261. So yeah, I mean, I think minimally to here and potentially all the way up to here. So maybe 15 minimally up to 1550 and maybe up to 15250 in here today for the NASDAQ, depending on if this thing really starts to gather momentum. I could easily see a FOMO squeeze in here today because you had that pause on Wednesday. It was a really strong firm session yesterday, a really strong close, and we're back up overnight in here. So I can see this being a certainly an impulsive day to the upside in here today. A quick nod to commodity markets, and then we'll wrap up. So let's start off with the oil market in here. So I've had this really strong rebound. The market's been a little bit tentative yesterday, a dip lower in here and a dip this morning, but look, trying to swing in here already this morning. So I think there's maybe a little buy opportunity here on oil. And if we step into like 30 minutes, so you can see there's the dip, the bigger rebound in here we're seeing more recently. There's the rebound. Now that does look like a risk of a little topping pattern, and we do have lower lows and lower highs, but significantly we've held above, look, all these support levels here, these lows here, here, here. So we've got a string of lows in here that the market's held. It's actually held above the highest of these lows in here. So if I just make this a bit bigger, so this swing low in here is at 109.05, and then overnight we're at the low 109.14. So it's held this low here, right? So, and really this is like the last major low before the high, right? So look, this is and then you haven't got a little swing low there. I mean, you've got this little one here, but this is where the impulsive move really comes. The last impulsive move comes from here, and it holds here. So even though you've got these lower lows and lower highs, we've held here, and look, not only held once, yeah. So if you go across here, I'll stick a horizontal line in. So that swing low there. Yeah, we've held that. Not only held once, so this is a 30-minute chart, about an hour and a half ago, okay? We held again in here, actually not an hour and a half ago, about 3 hours ago. We held here about 3 hours ago, and then we held here again in the last hour, okay? Again, so the low there was 109.28. So 109.28, 109.14, holding this low here at 109.05. I think I'm pretty sure I flagged 109.05 as the important level to hold today on my reports that you can download. So look, we've held there. Whilst above here, look, and we're swinging back higher. This is a 30-minute chart, right? Yeah, 30-minute chart. This is a positive little candlestick, the last candlestick, a little hammer. So the market's down, hammer back up, pushing higher. I think we've got you've definitely got this counter trend line. So if I just zoom in a little bit, you've got this counter trend line off the top. Now this one's not going to be much good to us. Okay, but then we take the next one, maybe stepping down through here. So you've got this counter trend line here. You can see it's a good trend line. Why? Because you draw it off of here, you draw it off here. The market went back up there a couple of hours ago and failed at the trend line. So this is an important trend line, okay? If we can get back above this trend line, so that trend line at the moment is going to come in around 111.80 kind of area, and you got that failure peak there at 111.91. Back above, I think, I want confirmation above 111.91. This swing high in here will also be a reversal of this trend line. I think then that quickly opens up these peaks and then also this shallower trend line. So I would be waiting for confirmation, waiting for above 111.91. Now I know that's some way away, but I'd be waiting for that, because this market's, remember, moving $5, $6, $7 a day, right? So you can easily wait for a move above that peak in here to buy, and then there'll still be potential upside from here. So I'll be watching for a break above there. If you're much shorter term time frame of going into a 5-minute, look, what have you got in here? Well, that 111.91 level gives you a double bottom down here. You'd probably be going in through these little peaks in here. See these little failure peaks? You've got a string. These are what I call ceiling top, ceiling resistance, because you've got all like 1, 2, 3. They perform a ceiling. And if you've got the equivalent down here, these become basing. Yeah, so basing platform supports. 1, 2, 3 little platform supports, and here ceiling supports, ceiling resistances. Sorry. So in here we've got highs at 110.79, 110.79 again, and 110.76. Clearing through there. If you want an earlier entry point, I think up through there or here on the 5-minute chart easily takes us back up to this peak in here, and obviously through that peak is also through the trend line, and then it opens up those higher peaks that we just looked at. So, and then you can have an easy stop, going long through here, go for a target, up towards like 113 plus, and then you'd have your stop out, probably below this swing low in here. Okay, so looking for that next swing higher, maybe up through these peaks in here. Okay, that's what we've got on oil. Gold again, it's a little bit more bullish. We've broken out from this range. Want to just check that I've got the right. I'm just checking here offline. You won't be able to see, so I'm just going to double check. We're still front month on gold in here. Let me see. Sorry. Where's the liquidity in the gold? No, I think we're actually rolling onto the June contract. So I've got not this on the June contract. So I think if we now add in the June, I think if I zoom in now onto it should get the data might be a bit spotty on this contract. So let me look on the 5-minute chart. Okay, you still got decent data, so you still got decent price discovery. But maybe I think potentially, I'll double check this, guys. But I think maybe rolling over onto the June contract on gold. So GC now will be the contract, maybe rolling onto, I think, on gold. But we will double check that and come back to you. Okay. Seems like there's still, I think there's open interest now. Looks like it's 402,000 contracts in the June contract. So looks like June in here. But if we go in here, I've got it on the 5. Let me come out of that, go to the daily. We're broken to the upside anyway. So that we're in this kind of consolidation range in here. Get rid of this old analysis in here. But you see we're in this little range on the daily, and we broke yesterday to the upside, and then a little setback in here today. Looking to probably buy into that in here. So if I'm going to close down these old gold. You can see they hit the bells. So where are we? Gold. Let me get rid of the old contracts in here. So I've just got them off the sheet. But I'm pretty sure we're on June in here now, guys. But if I add in another one, so GCM as well for gold. And then I'll go to a narrower chart, short-term chart in here. We'll go into like 30-minute. So there's the breakout. So we're in a range environment. Remember the last few days I've been saying, I wouldn't touch this, got no strong view. Market's been kind of chopping in a range. In here, this chopping in this range. But then we broke out, got higher highs and higher lows now. You now got a couple of lower lows and lower highs, but we are swinging back. I did get an impulsive move. I'm still not 100% on this one, to be quite honest. Gold, you've got like this trend line here that's intact, but then you've got obviously this more accelerated trend line that's been reversed. And then look, it's kind of played with the trend line, then very impulsive. This is 30-minute chart. So this was just over an hour ago. Impulsive move lower. You got lower lows and lower highs. I'm a little bit stuck on this one, guys. I mean, if anything, maybe waiting for the rebound. You can see an argument for selling it in this zone up here around 1960 on the June contract. I can see an argument for waiting for a buy opportunity down here if it comes down towards this trend line and these chart supports over here down towards 1940. In here, I've got a little bit no man's land, not quite sure. So no strong view for gold in here still at the moment for me anyway. All right, guys, I'm going to wrap it up there. I'm going to wish you not only a great trading day, I'm going to wish you a fabulous weekend. Take care out there. Stay safe. Enjoy your weekend. And I'll be back with you for another webinar on Monday. Bye.